Hello, everybody. So, this is the lecture for the first chapter of the Introduction to Quantitative Finance class. This is chapter 0. This chapter will be very non mathematical, it's mainly qualitative material, which is meant to give a background understanding about important financial instruments. So, if you like mathematics and you want to have deeper quantitative content, this is left for subsequent chapters. But at this level, it's going to be mostly qualitative material. So, what are the objectives for this chapter? It's to understand funding methods for corporations. Basically, the main two approaches to obtain funding, which are through raising equity or through debt issuance. And um, describe the process by which companies raise capital through these two approaches. So in general, corporations they need to access capital to fund their projects. So for example, if a company needs to build a factory to operate and to produce some devices, well, they'll need capital to perform that duty. So there are many ways in practice companies can access capital for such purposes. So sometimes companies can do that through their revenues, but sometimes they don't have enough short-term revenue, so they need to access additional capital right now to produce some revenues later on. So there are many ways that companies can raise capital for the purpose we just discussed, and all of which have different implications for the company. So we're going to discuss two main classes of approach. The first one is debt. So debt can take the form, multiple forms, such as bank loans or bonds. Or the second category or second approach is through equity issuance. So equity can also take many types, many different forms, such as private equity, regular stocks, preferred stocks, all uh, all some approaches which we will discuss more in depth subsequently. Okay, so we will discuss all such funding methods in the remainder of the chapter. So, what is debt? We said there are two main approaches to get capital, debt or equity. What is debt? First, debt is when a company enters a contract to immediately receive a cash flow from a financial institution or another investor, which is called the creditor. And then the company agrees to repay the lending institution through a future stream of cash flows determined in the contract. So the company, which is called the borrower, receives money or capital right now and agrees to pay back that money plus interests in the future. And in debt, the requirement to pay back the lender is legally binding. So if the company decides not or is unable or decides not to repay its debt, then it will face legal consequences. It will this can lead to litigation. So, for example, if the company cannot repay its debt, it might undergo bankruptcy. So the creditor, the institution which lent the money to the borrower, can seize the borrower's assets as compensation if the borrower is unable to repay its debt. Furthermore, when the contract is written for debt, the company agrees to repay a stream of cash flows to the lender, but this stream of cash flow takes into account the time value of money. So, of course, when an institution borrows, um, let's say X dollars right now, it will have to repay more than X dollars in the future to take into account interest, which stem from the time value of money. Okay, so the stream of cash flow that has to be repaid depends on interest rates charged by the lender for the capital. Okay, so we discussed debt, but debt can take many forms. So, for example, there are multiple ways of accessing debt capital for companies, such as loans and bonds, which we will discuss next. So, what's a loan? Well, in a loan agreement, some financial institution, which can be a bank, provides debt capital to the company. And loans are highly customized or customizable. So the repayment schedule and all details about the loan can be tailor-made to accommodate both the borrower and the lending institution. Okay, so loans is the counterparty is typically a financial institution. The repayment schedule can be very flexible, and the institution can work out details with the borrower so that both sides are happy with the customization of the contract. Furthermore, the creditor, which is the bank in that case, will access confidential information about the borrower for monitoring purposes. So let's say a bank lends you money, they are, if you're a company, then they are able to access and practice additional information than what's publicly available. So what's publicly available, for instance, financial statements, can be accessed by the bank, but the bank will often require more documentation about your operations to monitor your actions and make sure you are not likely to go insolvent. So, moreover, loans are often linked to what we call covenants, which are restrictions to actions that can be taken by a borrower. So, for example, if a bank lends money to a corporation, the bank can require the corporation to keep a small debt ratio or a debt ratio which does not exceed some threshold, for example. And these restrictions, they are written down in a covenant, which is a part of the contract underwritten between the bank and the financial institution. So when you borrow money through loans, if you're a corporation, this often comes with both restrictions on your action to make sure you don't do anything too risky and the bank is too likely to lose their money. And you also often have to give confidential information to the bank. So when the lending institution lends capital to the borrower, they face the risk not to be repaid. Okay, so for example, if a bank lends money to a company, if the company is not successful, it might not be able to repay interests in the capital to the bank. So, in practice, the borrower might be unable to repay back the money it borrowed, either unable or unwilling. In that case, it's called this risk for the borrower, it's called credit risk. So the credit risk is the risk if you're a financial institution that the company to which you will lend money will not want or will not be able to repay you. And of course, the higher the credit risk is, the higher the interest rate that will be charged to the borrower will be. So if you're a bank, you will charge more interest to companies that are more unlikely to repay you back because you want to be compensated for this additional risk. Now we will discuss collateralized loans. So in practice, we said that financial institutions, they charge more interest to companies which bear more credit risk, so which are more likely not to repay the money back, and for which the bank is more at risk to lose a larger amount of money. So, in order to be able to secure a more advantageous or favorable interest rate, some companies use what we call collateralized loans. So, in such an agreement, um, the um, the borrower uses what we call collateral. So, what's collateral? Collateral is an asset from the borrower that can be used as a guarantee in the case the borrower defaults. Defaults means doesn't is unable to repay the money it borrowed plus interest. Okay, so how does this work? Well, if the borrower defaults on their planned payments, then the lending institution can seize that collateral to be compensated for not being repaid by the borrower. So, to make sure this asset can be seized by the borrower in the case of default, the collateral it cannot be disposed of by the borrower as long as the loan is active. Okay, so in a nutshell, in a collateralized loan, the borrower offers an asset and guarantees. So they say, okay, if ever I default on my payments, you, the financial institution, will be able to seize this asset, and to make sure you will be able to seize the asset. In that case, I'm I won't dispose of this asset. I'm forced to keep this asset. I cannot sell it. Okay, so collateral is just an asset offered in guarantee in case the debt cannot be repaid. So, for example, for retail loans, meaning loans to individual, the house in the mortgage loan is often the collateral. So, if somebody cannot repay their mortgage payments, then the bank can is able to seize the house to be compensated for the losses. So, in practice, when companies have loans, they don't hold a single loan at a time. They typically hold loans from many financial institutions for many different projects. Okay, because the funding requirements throughout the life of a company is not constant through time. So at times the company might need to make more investments, so borrow some more money, and at other times in the life of the company is able to uh, live with less capital and they're able to repay their loans. So when you have multiple loans, in the case of a default by the company, there needs to be some mechanism to determine which of the companies or lending institutions will be repaid first. So if a company A holds two loans at bank B and C, and company A defaults or goes into bankruptcy, uh, we need to be able to determine which of bank C or B will be repaid first throughout by seizing the assets of the company. Okay, so uh, these type of considerations they're often stipulated in the loan agreements. So when we talk about a senior debt, it's a debt which has a high priority uh, to be repaid if the company defaults. Whereas subordinated debt, it's a debt whose creditor has a lower priority in the order in which uh, lenders will be repaid if the company defaults. Okay, so if a company defaults, senior lenders will be repaid before subordinated lenders. And by repaid, I mean, let's say the company goes into bankruptcy, the assets will be liquidated, and the proceeds of the liquidation will be given first to senior borrowers and then after to subordinated borrowers. Okay, so in the legal agreements of the debt, who is a senior borrower and subordinated borrower is determined. Okay, it's written down in the contract. Okay, so loans were a first way to access debt capital for a company. A second approach to access debt capital is through bonds. Okay, the issuance of bonds. So how does this work? If you're a company, you issue bonds. So some investors will buy the bonds, and the sales of the proceed will act as capital for the borrower. Okay, so you're a company, you issue bonds. Investors which buy the bond uh, give money to the company through the purchase, but then in exchange, the borrower they agree to repay bondholders through a stream of cash flows determined by the contract, the bond contract. Okay, so if you're a bondholder, you purchase a bond, so you give money at the onset, but then in the future, the company agrees to repay back monies you've given to them through a stream of cash flows, which contain either what we call coupons or capital payment. So a zero coupon bond is a bond for which a single payment is provided by the borrower at the maturity of the loan, whereas a coupon bonds is a bond for which the borrower or the company repays a sequence of cash flows repaid periodically. So at every, for example, semester or every 6 months, the borrower pays back the investor's interests on the capital provided or on what we call the face value of the bond. And then at the maturity of the bond, then the borrower repays what we call the face value of the bond. So the capital provided to the company. Okay, so what are features of the bonds? First, bonds are traded on financial markets. So this is different from loans. Loans aren't traded on markets. You need to go see a financial institution to if you want to subscribe to a loan. Whereas bond, you just go to financial markets and you can trade them on a, for example, exchange, or sometimes you need to have a bilateral trade, but still, this is on financial markets. And because they're traded on financial markets, they are much more standardized and less customizable. So we said loans, it's very easy to customize them to fit needs of the borrower, whereas bonds, they're kind of standard. They have a standard specification, so it's harder to customize them. Furthermore, if you're a bondholder, you typically don't have confidential information about the borrower. So if you're a bondholder, you can typically access financial statements or other informations available publicly, but unlike the bank in a loan, you cannot access private information about the company. And finally, bondholders, they have no control over actions of the company. So we said that if you're a bank, you can impose some restrictions on the actions of the borrower through a covenant attached to the debt contract. Whereas if you're a bondholder, you have no control over actions of the company. Okay, so this is another difference between loans and bonds. Okay, so bonds, we gave the general outline of how they work, but there are many types of bonds, multiple types. So, for example, there are fixed rate bonds. So these bonds are ones where the interest rate repaid by the borrower is fixed. So, for example, fixed rate bond is a bond which might guarantee an interest rate of 3% throughout the life of the bond. So, if the face value of the bond is $100, then the company will pay $3 per year throughout the lifetime of the bond. You have floaters. So floaters are bonds where the interest rate is tied to a floating or variable index, such as, for example, the LIBOR. Okay, so the LIBOR, this is a technical term, but this is an interest rate calculated by ICE, or the Intercontinental Exchange, which is company that does many things, but they calculate this index, and it represents the rate at which banks lend to each other for very short-term loans. So, for example, overnight loans. Okay, so details aside, floaters are bonds for which the interest rate varies through time. Okay, so fixed rate versus floaters, you can think of them as, you can make an analogy with your mortgage where you can pay a fixed rate or a variable rate. A third type of bonds is inflation index bonds. So in that case, the interest rate repaid by the borrower is tied to a measure of inflation such as the consumer price index, CPI. And finally, you have another type of bond which is called mortgage-backed securities. So these are bonds for which you have real estates or like, for example, buildings or infrastructure that is used as collateral in case the company is unable to repay the borrower, the lender in that case. Okay, so mortgage-backed securities, they're kind of collateralized bonds where you have mortgage houses or infrastructure that are used as a guarantee to the bondholder. Okay, so can we compare bonds and bank loans? So why would a company issue a bond, or why would a company subscribe to a loan? Okay, what are the advantages and disadvantages of both? Well, typically the interest rate paid on a bond is higher than the interest rate paid on a loan. Why is that the case? Well, if you're a financial institution and you provide a loan, you have more control over the actions of the firms through covenants than if you're a bondholder where you have zero control over actions of the firm. Okay, so you cannot prevent the firm from taking risks if you're a bondholder. Okay, this gives you additional risk if you're a bondholder than if you're a bank. Furthermore, the bank has more information, private information or confidential information about the borrower than a bondholder has, because the bank is able to access, as we said, confidential information if they offer a loan to a company. So because of that, bondholders, they have more risk than financial institutions which offer loans. So they need to be compensated for that additional risks. So how are they compensated? This is through charging a higher interest rate. So bonds are more expensive if you're a company, if you borrow money, because you are charged with a higher interest rate. But however, many mature company, they would prefer issuing bonds rather than having to subscribe to a loan, because they don't necessarily want restrictions imposed by banks, because restrictions prevent the company from taking risks, and sometimes it's these type of risks which allow you making profits. So sometimes you need to take some risks to generate profits, and companies want to access these profits. So even if bonds are costlier, they require paying a higher interest rate, they involve less restrictions to companies. So many mature companies, they still prefer issuing bonds rather than having loans. So we'll stop for this first part of Chapter 0 and we'll continue subsequently.